Welcome to the CoreLogic RP Data update on housing market conditions for May 2015. Dwelling values rose across most of the capital cities over the past month, with our combined capitals index rising by 0.8% over the month. The latest results take the year-to-date level of capital gain up 3.8% over the first 4 months of the year, and dwelling values are now 7.9% higher over the past 12 months. That's a slight rebound in the annual trend rate of growth after the annual rate of increase had been tapering since April last year. Looking at the cumulative level of capital gain over the entirety of the current growth cycle, capital city dwelling values are approximately 25% higher since values started trending higher back in June 2012. Every capital city has recorded some level of growth over the cycle to date. However, the diversity in performance is substantial from city to city. At one end of the spectrum is Sydney, where dwelling values have increased by 40.2% over the current growth cycle. The Melbourne housing market has also seen a substantial level of growth in local values, but is a distant second to Sydney, recording a cumulative level of capital gain of 24.5%. The Darwin housing market has recorded the third highest rate of cycle growth at 17.7%, followed by Perth at 13.7%. Brisbane at 11.5%, Hobart with a growth rate of 10.7%, Adelaide at 10.1%, and Canberra, where values have increased by just 6.8% over the cycle. Since the 25 basis point cut to official interest rates in February, auction clearance rates have jumped, particularly in Sydney and Melbourne, suggesting a positive response to the stimulus of lower mortgage rates across these cities. In fact, every week since the rate cut, Sydney's shown an auction clearance rate above 80%, while in Melbourne, clearance rates have moved from the mid-60% range to the high 70% range. Private treaty metrics also point to strong capital growth conditions, with the level of vendor discounting at 5.7% in March, having shown little change over the past year and a half. Meanwhile, the average selling time was recorded at 36 days in March, which was almost a record low and down from 42 days at the same time last year. Once again, these figures are largely being driven by low discount levels and a rapid rate of sale in Sydney and Melbourne. Rental rates are showing very little in the way of appreciation, with the median dwelling rate across the combined capitals increasing by only 1.7% over the past 12 months. Capital city rental growth continues at its slowest pace in more than a decade. The highest rate of rental growth is in Sydney, where renters are paying on average about 3.3% more to rent a Sydney dwelling than they were a year ago. At the other end of the scale are the cities where rents are tracking backwards. In Perth, median rents have fallen by 4.2% over the past year. Darwin rents are down by 4.7%, and Canberra rents have fallen by 2.6%. Most capital cities are still seeing dwelling values rising at a substantially higher rate than rents, which is causing a consistent compression of rental yields. The lowest gross rental yield can be found in the cities where dwelling values have grown by the most. Sydney, where the typical home is now providing a gross yield of 3.5%, and Melbourne, where gross yields are slightly lower at 3.3%. The highest yields are still in Darwin at 5.7% and Hobart at 5.3%. Let's have a look at the housing market conditions across each of the capital city regions. Sydney's housing market has caught a second wind since mortgage rates fell further back in February. Since that time, the rolling annual rate of growth has started to trend higher once again. Auction clearance rates have moved to new record highs, and the number of homes available for sale has reduced even further, creating a sense of urgency amongst buyers. Dwelling values across Sydney have moved 40.2% higher over the current growth cycle and are now 65% higher since the beginning of 2009. As dwelling values continue to surge to new record highs across Sydney, rental yields are being squashed and affordability is becoming even more challenging for many sectors of the market. The Melbourne housing market's been playing second fiddle to Sydney's rate of growth over the duration of the current cycle. However, across the previous cycle, which ran from 2009 through to late 2010, Melbourne value growth was outpacing Sydney's. The Melbourne market has seen dwelling values rise by 6.9% over the past 12 months. However, the majority of capital gains is being driven by houses as opposed to units. Melbourne house values are up by 7.6% over the past year, compared with a 1.9% increase in unit values. The softer performance in the Melbourne apartment market is probably, at least partially, attributable to the large number of new apartment projects that are adding new medium to high density supply across the Melbourne intercity region. Housing in Brisbane has continued to languish with regards to capital gains. Over the past year, Brisbane dwelling values have shifted by only 2.2%. Despite the relatively soft rate of increase, the fact remains that this is the third highest annual rate of growth of any capital city. Brisbane's housing market fundamentals remain strong relative to the larger capitals, with yields above average, affordability much less of an issue, and the growth cycle to date is still immature. The missing ingredient seems to be an active labour market, with unemployment higher in Queensland compared with New South Wales and Victoria. Adelaide's housing market is coasting along, with the rate of capital gain roughly keeping pace with inflation. Dwelling values moved 1.7% higher over the past 12 months and have risen by a cumulative 10.1% over the growth cycle to date. Transaction numbers are continuing to trend higher across Adelaide, with a number of home sales increasing by 6.2% based on a year-on-year measure. Rental yields are above the capital city average at 4.2% for houses and 4.8% for apartments. In Perth, the housing market remains relatively soft after recording strong capital gains early in the cycle. Dwelling values rose over the past month but are down by 2.2% over the first 4 months of the year. Rental markets are also softening, with local Perth rents down a bit more than 4% over the past year. Listing numbers are also rising across Perth, which indicates newly advertised properties aren't being absorbed as quickly as they've been added to the market. Perth buyers now have more time to make a purchase decision, there's more stock to choose from, and they have more ability to negotiate on price. In Hobart, the housing market appears to have slowed, at least from a capital gain perspective. The annual rate of growth had been improving over most of 2014, reaching a recent high point of 5.2% growth over the year ending November last year. Since this time, the annual rate of growth has slipped back to 1.2%. Transaction numbers have shown some improvement though, with a number of dwelling sales up 1.5% over the past year, and Hobart is now recording the second highest gross rental yield of any capital city. After recording the strongest growth conditions over the past decade, the Darwin housing market's now recording negative annual growth, with dwelling values down 1.6% over the past 12 months. That's the weakest annual performance of any capital city. Yields have maintained their strong standing though, with Darwin continuing to offer up the highest gross yields across the capitals. Weekly rents were down 4.7% over the year, which suggests Darwin yields are likely to reduce as strength in the rental market dissipates. Canberra's housing market has reversed some of the recent gains recorded earlier this year, with dwelling values falling 1.5% over the month. The annual rate of growth remains very low at just 1.1% over the past year. Canberra rents are moderating as well, down 2.6% over the past year. The weaker rental conditions are likely to pull gross rental yields lower across Canberra, with the current gross yield on a house reducing to 4.2%, while units are attracting a typical gross yield of 5.0%. Clearly, the low interest rate environment isn't the only factor that's driving the housing market. If it was, we'd see a much more consistent rate of growth in dwelling values across each of the capital city housing markets. Strong economic conditions in both New South Wales and Victoria are another factor driving the Sydney and Melbourne markets, as is ongoing strong population growth and healthier labour market conditions. Mortgage demand remains relatively strong. However, across the broad borrower categories, there are some distinctly different trends. New owner-occupier home loans have tracked relatively steadily throughout the past year, increasing by 0.8%, while refinance loans have increased substantially, up more than 28% over the year. The high rate of refinancing reflects not only the low interest rate environment, but also the fierce competition for lending across the banking sector. Investor demand is also tracking higher, with the value of investment loans up 9.9% over the year. The most significant increases in investor demand have been contained within New South Wales and the Victorian markets. We're expecting the rate of growth in investment lending to slow down over the first half of 2015 as APRA becomes more vigilant on investment lending, and lenders are placed under further pressure to ensure the value of their investment lending doesn't grow at a rate materially above 10% per annum. Although we expect this to occur, the more up-to-date housing credit data shows investor credit rose 0.9% in March and increased by 10.4% over the year. That's its fastest annual rate of growth since February 2008. Relatively low consumer confidence, stricter serviceability requirements for borrowers, tighter lending conditions for investors, and affordability challenges, as well as low rental yields, are all factors that may contribute to a moderation in housing market conditions over 2015. These factors could be somewhat offset by the low returns from risk-free assets, and interest rates for residential mortgages expected to reduce over the coming months. The ideal outcome for the Reserve Bank under the current and potentially lower interest rate setting would be that housing market conditions continue to moderate back to more sustainable levels, but housing demand remains strong enough to keep dwelling construction at the current high levels and new home sales relatively high. To date, we've seen a moderation in growth. However, the rebound of value growth in Sydney is no doubt likely to be creating some headaches for both the RBA and for APRA. Thanks once again for viewing our latest housing market update. Of course, you can always find fresh and interesting research on the local housing market at our website and research blog located at www.corelogic.com.au.